All right. Well, in an effort to be respectful of everybody's time, we will go ahead and get started. So thanks to everyone for joining us today. We're really excited to talk about non-QM loans. And we're going to answer a few questions. What are they? Who are they for? And how can you open more doors for your clients? So our goal in this session is to give you a clear, practical understanding of how non-QM solutions can help you grow your business and of course, strengthen your relationship with us at Bank South. So I'm going to introduce our panelists. We have an awesome group of folks today to join us. We have Angela Botnick, who's our head of operations here at Bank South. We've got David Holmes, our COO, Derek Walton, our secondary market manager, and we have Van Evans, who's a part of our training staff here. So let's go ahead and dive right in. We'll get started. We'll bring in Mr. David. David Holmes. David, tell us, what are non-QM loans and how do they differ from traditional mortgage options?
Well, good afternoon, everybody. Non-QM loans, it stands for non-qualified mortgage. And what that means is these are mortgage loans that don't meet the strict underwriting standards that were set by the CFPB for qualified mortgages under the Dodd-Frank Act. Um, to me, they're an extension of what we used to call Alt-A loans, but just have pulled out the positive aspects for those loans. They're not subprime loans, but they just have alternative underwriting options designed for creditworthy borrowers who fall outside your normal guidelines. A couple of examples that are used for non-QM loans are self-employed borrowers with complex income using their bank statements instead of tax returns. They may be savvy and able to leverage certain tax um, situations, but at the end of the day, they have cash flow and are great borrowers. Real estate investors using the debt service coverage ratio, and borrowers needing interest only or asset depletion loans. How they differ from the standard underwriting guidelines and from your normal Fannie Freddie type loans, several areas, debt to income ratios, different ways of calculating income, and broader guidelines and broader occupancy LTVs and so on. So it's really just great loans, good credit worthiness that are just a little bit outside of the box with a different way of interpreting the documentation.
Got it. Thanks for sharing that. And I appreciate you breaking down some of the areas that we're going to dive into just to give a peek of what we're going to chat on. So let's go over to Derek. So, Derek, how can knowing about non-traditional products help agents win more business?
Well, I think the short and sweet answer to that is it deepens the pool of possible buyers, sellers, borrowers, which ultimately means you have more options to sell homes and close loans. Like David mentioned earlier, more and more of our potential borrowers and buyers are qualifying with income other than W-2, and so these products allow that type of qualification and allows a borrower to still get into a home and ultimately close a deal. I think it also, the other thing I would point out is it gives you kind of an ability to tap into some new referral sources. So, think of something like, financial planners or, estate attorneys, folks that may have, high value clients or folks that have a little bit different income or just have a lot of assets or things like that. And so it gives you a possibility of opening up, some other sources that you may not be mining currently.
Yeah. Great points. No, I like what you said at the beginning there. Just more opportunities for us to be able to say yes, I think is extremely important. I think there's always those cookie cutter loans that we're kind of familiar with, but I think whenever you hear a unique situation, sometimes it feels like there's not going to be a solution. But then when we look in the non-QM pool, there really is a lot of options for us to be able to get those loans to the closing table as well. So thanks for sharing that. So we'll go over to Angela. Angela, what are some of the most common questions you hear about when it comes to non-traditional lending?
Well, on our bank statement loan, I get a lot of questions. Well, how do we determine the income? And we take a 12-month average of your bank statements, usually a business account, but we can use with personal bank statements. And we use the deposits that are usually predictable and showing regularly. And we apply an expense ratio to that. And that's how we determine their income. And there's no tax returns needed. They don't need to sign a 4506C for us to obtain the tax returns from the IRS at a later date. And then on the debt service coverage, a lot of questions just revolve around what does that mean? And that means what you take the rent and you divide that by the principal, interest, taxes, and insurance of the housing payment. And we're usually looking for a 1%, ratio. So, or a little bit higher, meaning that we want the rent to be more than the payment. It is certainly possible to do it with a lower than 1 ratio, but with a little different guidelines, but that certainly is an option, and we don't have to verify any income, or the application looks completely different. There's really no income or employment on it at all. So those would be my 2 main questions I received.
Awesome. Yeah, thanks for sharing that. And we're going to dive in a little bit here on just more, applications. So let's dive in a little bit deeper into 3 key areas of non-QM, or also we'll refer to it as flexible lending. I think is a popular term. So the 3 areas are going to be self-employed, investor, and credit challenge. So let's talk a little bit about application and how we utilize these day to day. So let's start with self-employed. I'm going to bring Van in. So Van, let's talk about a problem. We have let's say we have a self-employed customer who does not fit within your normal W-2 lending. So we have someone that's self-employed and they, maybe just like David mentioned, maybe they're a little bit savvy on their taxes. One of the solutions that we bring in would be a bank statement program. So we're going to be able to utilize a lot of the income that we see coming in on those bank statements. So Van, we know a large majority of home buyers are self-employed. So how does a non-QM lending option offer solutions for a self-employed buyer specifically?
Yeah, no, it's a great question. And, that's exactly what Angela was just talking about as well. One of the major income solutions for self-employed borrowers is being able to look at their 12 months of bank statements. A lot of these, self-employed individuals work with accountants and CPAs to maximize their tax deductions. So a lot of those borrowers may not show all of the income, on their tax returns because of write-offs, right? So, but there's plenty of options in the non-QM, or what we call sometimes non-agency arena, where we can help qualify borrowers. Again, as Angela mentioned, looking at 12 months of bank statements. They can be either personal bank statements or business bank statements. And a lot of times what our, originators will do when they're talking to prospective borrowers is that, they'll look for both options. As a fiduciary, the loan officer will ask for, their tax returns. Look at your tax returns. Let me see if we can qualify full doc for an agency loan. But also with a bank statement loan, you have that additional option where an originator can ask for, show me your 12 months bank statements. And it could be multiple businesses. They could have 2 or 3 or 4 different businesses with different sets of bank accounts. And the originator can ask, or the loan officer can ask for those bank statements, and we'll run the income for you. So we can look at the tax returns and the bank statements, and then go back to the borrower and say, hey, we looked at your full doc as an option. You make $100,000 a year, for example, not bad. But over here, we ran your income on bank statements and we show you make 200 grand a year, because we're looking at the deposits through that bank account. And maybe now there's an option for you as the realtor, or for that borrower, that maybe they can now buy that larger house they really wanted, or maybe that refi they really needed. So it definitely opens up a lot more options for those types of customers. So that is one option. And there's other options as well. The bank statements is a big one, but there's also 1-year P&L option as well. There's 1099 only products. So there's multiple facets to the alternative income solution arena in the non-QM space.
Gotcha. Yeah, I really like what you said there when it comes to checking both, because I think we have that responsibility to say, okay, well, what's going to be the best pre-approval for you? Because there's some super competitive options in the bank statement world. And maybe if that means, allowing that person to shop in a pool of homes that they were looking to be in, we can utilize those bank statements and have a higher pre-approval. So that's a really good nugget. All right, so let's talk about situation number two, and that's going to be our investors. I'm going to kick it over to David on this one. So David, let's talk about investor loans and primarily the biggest issue we run into when it comes to investors is maybe we have an investor that has, multiple properties. They've got different, rent schedules on each one of those properties, and maybe all of a sudden we're running into some DTI issues. So that DTI is going to limit what, them being able to expand their portfolio. So one option that we utilize would be a DSCR loan. So a DSCR loan is going to allow us to let that investor purchase that property and focus more on the rental income of the property rather than maybe their own debt to income. So David, why is DTI often a roadblock for investors? And then how can non-QM lending offer a solution?
Well, most of the time, investors have multiple properties. You don't run into people who have one or two properties. It's 5, 6, 10, and we'll see even 15 and higher. Obviously, they're going to have some tax leverages with depreciation and writing off expenses. So while they may have positive cash flow, their DTI just does not get to a comparable level that would qualify them for agency type guidelines. The DCR loan is perfect for those guys because it is basically just a cash flow loan of that particular property. If the rental value exceeds what their PI TA is going to be, then you approve the loan. You don't get caught up in analyzing all those other properties. So it's an extremely popular program right now. Underwriters really love it. So instead of 7 pounds of tax returns, you've got a little bit of a thinner file, and it's really an asset-based loan looking to make sure there's positive cash flow. And so far, the loans have been tremendous, and they've been performing quite well also.
Really good insight there, and I think that's really important. It's a super popular option right now that we're originating a lot for investors. So thanks for diving into that. All right, so question number three. Let's talk about this is an interesting one, I think, to me. Credit challenges. So Angela, a question on credit challenges. So let's say this the problem on this one. Maybe you have a customer who has, maybe recent credit events, and those credit events have blocked them from being able to qualify for, let's say, a conventional loan. So the good thing is non-QM loans do offer a lot more flexibility. They have, a lot more insight on risk management that allow us to be a little bit more flexible. So Angela, how do non-QM programs help buyers re-enter the market sooner after a credit challenge situation?
We do have programs available in the non-QM space that will let the borrower close or qualify for a loan as soon as a foreclosure is finished. So it could just be a few days old. And same with the Chapter 13 or Chapter 7 bankruptcy, or 120-day late on the mortgage in the last year. So it does have that flexibility. It is, again, an asset-driven product, so it is looking for a larger down payment. But again, with a 620 credit score and a 30% down, you could be one day out of foreclosure and qualify for a non-QM loan. And you could use bank statements as your income source.
Wow, that's a huge nugget. I mean, we run into that kind of stuff all the time when it comes to qualifying customers, and you see these things on credit. And for those of you who may not know, some of those events, can be upwards of 2, 4, 5 years of wait period before they're eligible to purchase again. So being able to have another option that can get them in the game sooner, I think that's really important. So thanks for sharing that. This was me for Van and Derek. I'm curious to hear from you all. So what's one final takeaway for agents and builders about incorporating non-QM loans into their business strategy?
Van, you want me to go first, or you want it?
Fire away, Derek.
All right. So I think from kind of like a secondary standpoint, I mean, ultimately, you're out there trying to sell more homes, and we're trying to close more loans. And so I think, these products, you need to be in your toolbox. You need to be able to offer them, and you need to know about them. I mean, they will get you more deals. They will help more borrowers ultimately get into those homes. And I think that you're setting yourself behind your competition if you don't have the ability to originate these transactions or help your borrowers get into these types of loans. I also think real quick that one of the things that used to scare a lot of folks with this type of a product was the difference in rate. And we've really had a benefit due to a larger an increase in liquidity in this space over the last few years, which has gotten a lot more folks that buy these loans that want to put these loans in their portfolios. And so the gap from a conforming type rate like a Fannie Freddie to a non-QM alternative type product is not as wide as it used to be. So I think your payment shock stuff that you may have used to have is not as big of a deal these days.
Yeah, and I'd say, I want to add two things, Connor. I hope you don't mind. I think we have some time. Just remember that this non-agency space, a lot of these borrowers are not bad borrowers. They're not credit criminals. These are story loans a lot of times. So, there's a forensic review on these loans sometimes that you can get a better understanding of their businesses or if they're an investor. But they may not always fit the box. So exceptions are possible. You could, as far as a production we're doing, anywhere between 20 and 30% of the non-QM arena is exception based. Sure, there's guidelines and there's matrices, but there's also an understanding that these types of borrowers may not fit perfectly, and they have compensating factors. Maybe they have some extra reserves or assets. And those are things that we can look at and still consider these borrowers. So even if you come across a situation that you may think there's not a chance, or the borrower may not be considered for home ownership, it doesn't hurt to always reach out, right? Doesn't hurt to reach out and just, you have this prospective buyer that might need some massaging through the process. Those things are available. I would also mention, talking about what David was talking about DSCR products and investor products. Anybody have any idea year to date of all the purchase business being done, how much are investment properties? I'll tell you, it's 30%. 30% of all purchases year to date are for investors. So if you're looking at your type book of business, if you're not at 25, 30% of your business that's investor based, you're under indexing yourself. That means someone else is getting that business, and that's an opportunity, right? So a lot of these borrowers, are business purpose business entities where it'll allow you to network with these investors that you can, and David mentioned this as well, that a lot of times you can see, 3-4 loans come in at a time, or at least you have that good relationship of that investor. Maybe they're looking to refi or purchase, or maybe they have a strategy. They want to buy 5 properties this year. So this is like a trickling amount of volume coming in on a monthly or maybe annual basis. So these are relationships you can network with, and it's not just a consumer purpose loan where that one borrower is just buying that one property and you may not hear from them again for another 7 years. Investors, they'll come back to you. They'll keep coming back to you for listings or to look for properties, et cetera. So a lot of opportunities in that space.
I would also add one more thing too, like on that, like you were saying, Van, the ability to close those loans as well in an LLC, for instance. It doesn't necessarily have to be an individual borrower's name. These things can vest in an LLC. So, like David mentioned earlier, you see some of these institutional type investors, that's what they do. They have 30, 40, 50 properties, and all of them are in LLCs. You have the ability to close those loans that way as well, or sell those homes, I guess, too.
Yeah, you're going to find a lot of those investors that are going to demand their loans to close in an LLC, which is great for Bank South because a lot of companies don't allow that, because it's just different. But we have it figured out, and we're able to definitely close loans in a business entity, an LLC, and it affords those more mature investors some protections and some liability protections. But yeah, those are some of the areas that are most helpful.
Awesome. And you know what? I know we have a little bit more time, so I do want to bring it back because Van, you brought up a great point, and this will be somewhat of a group question. So Van, you brought up a great point about how much of the buyer pool is investors, and if we look at these non-QM loans or non-traditional, we'll start to see that year over year they've continued to grow to be a larger part of our business. And I think that, speaks a lot of volume as to, the necessity and where our industry is headed. So tell me a little bit, I'm curious to hear from everyone or just anyone that wants to chime in. What do you think you see as far as this growing as a larger part of what we're doing in 2026? Where do you see non-QM loans going? And do you think they're becoming a bigger part of our business? I'd love to hear a little bit more of your opinion on that.
I think the gig employees are going to be big. I think that's going to continue to grow. And like Van mentioned, you have you have all kinds of income opportunities and documentation with 1099s and P&L. And I think that portion of the employment area is going to continue to increase. And I think with AI eliminating probably some jobs, you're going to see a lot of different types of opportunities for people, and they'll have to adapt. So I think we will see more alternative employment situations like that.
Yeah, and also just to piggyback off of David, the total mortgage market expectations this year for 2025 is going to be a $1.9 trillion market, right? Of that, non-QM is going to be about 100 billion to 125 billion. What does that mean? All right, let's compare that to last year. Last year was the non-QM market was about 75 billion. So it's by far a bright spot in our mortgage industry. It's by far the fastest growing segment. Generally the agency space has been kind of flat, as far as productions. We've seen some tick up here and there with recent drops in interest rates. But the non-QM borrower, what's exciting about those types of borrowers is that they're not interest rate sensitive. This is solution-based lending, right? So it can't be about the interest rate. It's about being able to, how can I qualify for a property because I don't show income on my tax returns, or how can I get into this investment property and not provide all of my tax returns that has 30 properties on it. That's DSCR solutions. So that the opportunity, the growth potential is there, and we're expecting next year in 2026 to be about $125 billion market in the non-QM space. And I know we haven't touched on it either, but second liens as well. The second lien market has been growing dramatically. It's about a $60 billion market this year is expectations, and next year is growing even further. So there's opportunities there in the second lien market as well.
Wow. That's great stuff. And I really appreciate you, Van, putting the numbers to it. Like I mentioned before, I think that really helps people grab the scale of how these are growing and how much we're going to have to adapt to these being a bigger part of our business, but also how much we want to adapt because they're going to be an extremely helpful tool for all of us to be able to help those customers. So thank you so much for sharing that. And I do want to thank all of our panelists. We'll go ahead and close it out just to be right on schedule here. So thank you so much to our panelists sharing incredible information. Angela, David, Derek, and Van, we really appreciate you all chiming in and giving us that great insight. I hope there's a lot of nuggets that we were able to take away from this. And to close us out, I'd like to introduce Ms. Kim Nelson. For those who have not met Kim, she is our CEO here at BankSouth. And Kim, take it away.
Okay, great. Thank you, Connor. The panelists, you guys did a great job. And I wanted to say thank you to everyone today for joining today's conversation. What we covered here today isn't just about niche loan products. It's about expanding the runway for home ownership. These expanded criteria options give us the flexibility to serve creditworthy borrowers who just don't fit the traditional mold. That means that there are more paths to yes for entrepreneurs, gig economy workers. With the film industry here in Georgia, I think David mentioned that we have a lot of gig people who are paid by the gig. That makes it easier or harder for them to qualify sometimes because they may have had so many different employers in the last 12 months. They work on this movie or that movie, that kind of thing. But it also helps, other industries and people who have complex income. And here at BankSouth, we're committed to mortgage excellence. We do it with speed, clarity, and confidence at every step of the way. If today's session sparks a reason for you to reach out to a buyer that you might have been working with, or you need one of our loan officers to talk about an opportunity or run a borrower scenario for you, please don't wait. Reach out to one of our mortgage loan officers. You can find them at www.banksouthmortgage.com. And when you win, we win, no matter the market.
Thank you all so much for joining, and everyone, have a great rest of your day. And if you have any questions, please reach out to your Bank South loan officer. Thank you.